mine says
Yes.
it's unable to do it.
Okay. I think it's started. We're good to go.
Okay, so welcome everybody. We spent two sessions going through talking about building out your financials and keeping it lean and really focus on having cash flow and making sure that you're spending smart. And this session is all designed to bring an investor in to kind of talk to the same subject. So you understand from a founder's perspective, you've had the domain expert's perspective, and now you've got an investor's perspective on what that actually means. So what investors are looking for when we talk about smart spending, what investors are looking for when we're talking about growth metrics, what they're expecting to see at the seed stage. So this whole session every Wednesday, this obviously being our first one, is designed to just make sure that it's really transparent. And when you're going to go pitch seed investors, you kind of know what they're looking for, because there's not that much visibility on what good actually looks like for founders. So Seb, before we get into it, do you want to just introduce yourself and your fund and let us know a little bit about what you're working on?
Yeah, sure. Hi, guys. So I'm Seb. I'm one of the co-founders of Tripe Point's venture arm. We invest at seed stage mainly, although we do a bit of A and a bit of pre-seed, investing sort of between £1 million and £2 million tickets. So we're sort of leading your seed rounds or being a good co-investor in your Series A, or alternatively leading your pre-seed as well. We're focused on B2B software, so that's like my specialism, and I'm also the founder of a business that offers B2B software to funds, fund administration software. So I've sort of, and that business is live right now, and did its pre-seed and we'll be doing its seed soon. So I really have sat in the shoes of many of you will be either sitting in or are sitting in right now, and so can talk to you a little bit about what I expect from my own business, but also what we would look for as sort of top tier in seed stage startups, particularly today where the market has moved quite a bit, I think, over the last few months, and it's more tricky than it used to be 2 years ago.
Yeah, so this is what we spent a bit of time talking about on Monday, is the kind of growth at all costs versus sustainable growth and revenue, which seems to be the conversation point of today with investors. So do you want to talk about your opinion on that to start with? What are you expecting to see in terms of growth versus sustainable revenue versus both?
Yeah, and should we are we focusing specifically on the seed stage here, right? Because so I think that growth at all costs mantra has well past its peak. It was the sort of 2019, 2021, obviously the peak, coming down in 2022. And I think we're now in a little bit of a fairer environment. It's an environment where if you can get a product that people want to buy, there's money there, and quite a bit of money there, because investors are being more discerning. If you struggle with initial sales at seed, then it really hits you now, and people just don't want to touch you. And so it's become a little bit more binary. The market's sort of bifurcated. And what I mean by it's fair is that we're all in business, and I say we're all because me as well, right? As a VC with one hand and a founder with the other, we're all in business to ultimately sell a product that people want to buy. And that sounds so trite and obvious, but many founders get caught up in the operations, the product, the team, and sort of this feeling of I'm doing something, there's movement, things are happening. But then if the sales aren't coming in, it's really for nothing. At a bottom line, capital efficiency has become the most important thing at the moment, coupled with early signs of growth. Anybody can buy £1,000 Prada handbag and sell it for £500. And so what you have to be sure when you're starting to sell is that you're doing it in a way that brings in proper revenue to the business, ideally high quality revenue. And that doesn't have to be repeatable sales, those early processes you put in place. It could be people it could be you out and about rather than a team. But actually being able to show that you can sort of start to carve out a space in the market at seed, I think is really important. And when I look at what I would expect now a business from pre-seed to have achieved by the time they've come to seed, they absolutely need their product. It's probably a little bit on from MVP. MVP is sort of in that gap between pre-seed and seed. You need to have some customers. And I think it's really important not to kid yourself about this, because the thing is, if you don't kid yourself, you're going to go into these investor meetings and you're going to find them really easy. Most of the time, the problems arise, and I say this because I tell myself this every night, but like problems arise when you think, I've got these prospects, I think I'm going to make these sales, I think my product's wanted, I need to raise them, coming to the end of my runway, or my runway's running short. And you go out there and you start to try and pitch to investors, and they can see through this. They can see that, you know, you haven't got that traction. And you know, key things you shouldn't do are mix things like services or one-off revenues with ARR. That puts you in a bucket of you just don't know your business. And so these are really small things, like don't call revenue that's not recurring ARR. Don't talk about contracted ARR unless it's contracted and you really have visibility on it. It's like actually a signed contract. And when you do have it, really try and get those testimonies of those customers, because ultimately what's going to happen is those funds are going to go and ask the customers anyway what they think. So you might as well have that pre-conversation. And that shouldn't be too hard, particularly in B2B. I don't know how many people here are B2B versus B2C, but particularly in B2B, your customers will tell you to some extent what they want. Consumers are not so reliable for that. You can hear what they say they want, but you've got to pass it. B2B, you can sit down and you can say, what do you need? And it's not perfect, but it's much better than consumers. They do have a list of things they need. And if you can build that, often someone will buy it. And it's okay that your sales cycles are long when you're at seed stage. What you need to be showing is that you've built the product, a product that people see value in. You understand how to do that. And most importantly, understand that intellectual sort of partnering that goes on with your early customers, where you're sort of selling your product, but you're also testing hypotheses out and having like advocates. And actually, the blunt side of this is, if you don't feel like what I'm saying to you here is something that resonates, you're not like, oh, I go into these meetings and these people like the product. They might not buy it straight away, but they like the product. Then you're probably not quite close enough to product market fit. And that's where you're going to find it difficult to raise. And so that revenue point and that quality is just become really important. It doesn't have to be a massive amount. I'd probably say it's a six-figure number, 100, 200K, could be a couple of customers. You've just got to show that you've done that sort of dance with corporates. And you know, taking a step back, you need to ensure you've done it for a reasonable price. You haven't spent lots of money and effectively delivered not a lot of revenue. So raising tight at pre-seed is often a really good way to do things. I don't know how familiar you are. I'll stop in a second. You can ask a question, Perry. But like, I don't know how familiar you guys are with Paul Graham's ramen break even. Like, that is the thing people are talking about. I mean, I've been in 2 meetings this week with different VCs and they've both mentioned it. It's like ramen break even, this idea that you have to cut your costs, particularly founder costs, to show that you recognize break even is the end goal of a company. And unfortunately, VCs have done a disservice to all of us for the last few years, telling us that it's growth at all costs. It's not. Yeah, exactly, Lucy. Great. Yeah, and actually, Paul has a few of these sorts of anecdotes. You know, his default alive is along the same lines as this, and that's really impressive. Like, if you can come to an investor and you can say, I've raised 500 grand pre-seed and I've got 150, 200 grand of revenue, that puts you in a really good position, assuming it's recurring revenue. If it's not recurring revenue, then you really have to explain why the customers will be sticky. But that to me is like the perfect. And I think sometimes the straw man example is a great place to start, and we can ask other questions, but just knowing that if you're on that track, you are probably in a reasonably good place for when you come to talk to your investors.
Mm-hmm. There's, I think, about 40% of the cohort revenue generating currently. So 2 questions on revenue. One thing that we've heard is, as soon as you start generating revenue, it's actually more difficult to get an investment over the line because you're being interrogated on that revenue. So let's say you have got some revenue coming in, but it's not 100K plus. Yeah. Then does that put you on the back foot? And I guess the other question is, let's say you don't have any revenue yet. Yeah. Then what are you going to go in with? What metrics can you start the conversation with to prove that customer love? Yeah. So
I could say the sort of VC side, and I'll say the ruthless what I tell myself side. They're 2 different things, right? And I think to some extent, what I say as a VC, you should take a pinch of salt, and what I say to myself is probably what we should all really adopt. But as a VC, I would say that any revenue is better than no revenue, right? You're a business, you are designed to sell a product. If you don't have revenue and you think it's going to be easier, then it will work if you are, you've developed a relationship with those VCs. But I'm seeing peers be extremely discerning now at the moment. The market's shifting more towards the investor. And the last few years have been unprecedented in its founder friendliness. I probably, like some of you, I raised my pre-seed for my business and it took me a month. I mean, it's kind of crazy. Like, that's not acceptable. Like, that is like stupid. And that was peak 2021. And I imagine some people here will have been raising their pre-seeds in 2021 as well. And they'll resonate with them. We're now in a more discerning time, but if you come out the other end, you've really been tested, and you've probably got a very supportive investor there because they're doing fewer deals and they're sort of really testing you. So if you've got less revenue, I think you need to talk about the user story. Even if it's 80K, 50K, a customer, talk about how you understood the need and explain the need and explain. You should have more than one. Even if you've got one customer, you'll probably have 3 or 4 people you're talking to who've been giving you anecdotes on product roadmap, or have expressed an interest, but they're just a bit slower to buy. And talking through that understanding of the importance of commerciality is probably the priority if you don't have that sort of 200K revenue, because it sort of then talks for itself and the question becomes about quality. But I hear what you're saying, Purdy, about the whole, if you don't have revenue, you can start sort of like a pre-seed. You can start to talk about the idea still. I think that only really works at the moment in this market for businesses that are deep tech, businesses that patently require years of development. If you're, it's a good and a bad thing. AI is very hot at the moment because of ChatGPT. Whether or not that actually turns some investors off, it depends on the investor. Some will love it, they'll jump on the bandwagon. Others will actively dislike that sector. But that's an area that AI can be an area where it takes a long time. And so if you can build that narrative about your product being highly technical, that's a great way of explaining away why you don't have revenue. But if your product's not hyper technical and you've had a good crack of 18 months at building a product, you probably, it's a tough market. And it's a market where people will say, should your business exist? And I worry about that. My business did a pivot last year and we had to move aggressively fast. And so to sort of make sure that we showed some traction in our runway. Indeed, we are still. I'm sweating about it just this morning. And so I just think it's become a little bit harsher, but fairer. Like, if you've got that revenue, you will find those meetings easier than they were in 2021.
Obviously that you're coming at it from a B2B angle. Quick one, letters of intent or that kind of thing. Is that enough? If someone said, we haven't got any revenue, but we've got 3 corporates that have signed an OI and they're ready to press go, but the tech isn't there yet, so we need the investment to get there, kind of thing.
That's interesting. So I actually do think LOIs are worth something, particularly corporate. They do have to get buy-in internally to sign documents most of the time, particularly big corporates. And so it just sits below the revenue. But don't kid yourself, like 2K revenue is better than an LOI. But like, if you don't have that, an LOI is great, and you certainly should explain that, because for different products, it requires different amounts of time to sell in. Some industries, particularly if you're in a vertical SaaS industry, some industries are quite skeptical of buying, and that doesn't mean you don't have a good product. It just means that there's a great opportunity there potentially, but you just have to get over that trust line. Specifically on one thing you mentioned, which we didn't talk about, which is, what about consumer? What do you say if you're a consumer business? I think normally you will have data such as, it depends. Consumer B2B businesses, there are lots of similarities within at a high level, but consumer can be very, very different. You could be a subscription consumer, you could be one-off purchases, you could be consumer packaged goods, you could be consumer software, but you'll have an idea of usage, whether that is return rate to the website, whether that is time spent on your product, whether that is amount of money earned in a digital game, for example. Like, those sorts of metrics of usage are the thing to add in if you are a consumer business that doesn't have revenue. That could be monthly active users, daily active users. The actual metric has to be something you decide, and actually you'll be tested by the VC. When you turn up, you can say, our North Star metric is X because this is the derivative of revenue. Or, it might be revenue, but most North Star metrics, as you probably covered, Purdy, are not revenue. They are normally derivatives of the cleanest derivative of the revenue. And sometimes, whatever that is in your business, you can talk about that, and you can say, I've seen rounds happen where people said, I haven't turned the monetization on yet. What I'm doing is I'm building loyalty. But if I turned it on with these customers, it would equal this, assuming that 30% drop off or 40% drop off or whatever. That's very credible. Like that is also sits in that. If you're B2B LOI, you know, the equivalent is consumer, you know, usage metrics. So those are the metrics to go for. But I do believe that revenue sits above that, and you can complement lower revenue with these bits as well.
That's good to know. That's what I was going to ask you next. So have you got an example of someone that's pitched you and they've done quite a lot with a very small amount of money? Like they had a small pre-seed raise, or they invested some of their own cash, and they have demonstrated remarkable revenue or early customer love or any combo.
It's funny you asked that. I knew we were having this chat today. It's been in the diary for a while, and just yesterday, you know, these things always come up the day before you have a chat, right? I was talking to someone and I came to this epiphany. It's not a nice epiphany in the sense doesn't fit the equality diversity argument, but wealthy founders or second-time founders, if they've exited once before, they are really much more capital efficient because they don't need to draw salaries from their businesses or as much salary from their business. It's an unfair advantage they have, right? It's not fair. It's like we can spend time disagreeing on whether or not it should be the case, but the reality is that capital efficiency is prized right now, and it does bias towards people who have either savings or have had an exit, and obviously then savings as well, right? The second best from that is a founder that hasn't exited, business is either going profitable or like break even, or went a long way and failed. So you've got a lot of learnings and a lot of frameworks that you can use, because that also improves your capital efficiency. And so when you're coming to an investor and you're talking about sort of where I'm at, as a general rule, like investors will be quite flexible. You can raise 1 million, 1.5 million and have 100, 200 grand. You can have like a 0.1 ratio of sort of revenue to raise if you've done a pre-seed. But that's not best in class. That's just, I would say that's medium. You know, a lot of people have raised these big pre-seeds. Best in class is you've raised under 500 grand and you've got the revenue numbers we're talking about. So you're not hitting revenue equal to raise. I mean, that would be really, really staggering. And there are a couple of businesses, and I've seen one, and to be honest, by the time the debt came to us, they had 2 term sheets. And it just shows how investors just prizing that ability to survive, because that is ultimately survival, capital efficiency. So short of just being able to tap up your parents for some savings, which I know we can't all do, or having another business, the key focus is to just be showing that you have not overhired. So lots of people raise a round and they go and hire a team. You know, they might hire a dev and 3 senior devs because the CTO, if it's a founder, or a CTO if they're not a founder, might say, I want some help or whatever. I think with every hire, you have to be extremely purposeful, particularly at pre-seed. And I know you guys probably are, partly because of cash constraint, but the reason you've got to be purposeful is that if you hire someone and they're good and they want to hire someone themselves, you will not get 100% of their output. You might get 50% of their output because they're managing the other 50% of the time. And this is one of the problems that allegedly happened at Twitter at the scale, right? You know, Elon went and he said, right, getting rid of all the mid-level because there's too many mid-level managers of managers. Businesses at pre-seed and seed even, who have this manager of manager structure are looked down on. I look at it and if you've got a head of strategy and you're a pre-seed startup, you're doing it wrong. Like you should only have the roles that are absolutely core to making that first product and selling it to your first customers. And I've seen businesses. I mean, look at my business. 4 people can do it, right? 2 founders, and if they're not technical, a CTO maybe, or maybe even 2 founders plus 1 other person. It might be an ops person to leverage you or something else. You know, you'll often be the best product guy or girl at the beginning because you're talking to all the customers. You just got to learn how to use Figma, which I had to a couple of years ago. And so that is the key thing I would avoid when you're looking at capital efficiency, because that's what actually drags you down, that overhiring, that sort of idea that if I create 8 people, I'm going to grow faster. That is true when you have a product that's in the market and that you've got a sales process that's slowly but surely becoming systematized. But at the beginning, just hiring loads of devs to build a product, it can be a false economy. You should hire the fewest devs needed to get that MVP out there. And so that's probably what I'd say. If you want to just look at one thing, it's like, don't overhire in your business. It's good to be lean. It's good to be 3 of you at seed. It's good to be 4 of you at seed. 20 of you at seed, problem. And you might sit there and go, why? I'm never going to have 20 people at seed. We literally see that quite regularly. It's not abnormal. I'd probably say the median at seed is between 4 and 7.
That's the question that's just come in. I was just going to ask as my next question, which is, we've got a whole week where we're going to be talking about team structuring and best practice. But in your opinion, would you get kind of like a negative point if you outsourced your tech team when you're at the seed stage, if you're not technical as the co-founding?
So I'm biased here, Bertie, because I did it. So I've done that, which I think probably tells you the answer. But what I would say is, if you outsource all your tech team, big red flag. If you have a senior lead developer or CTO who manages a partially outsourced team and writes the code and checks the code and make sure there's good automated testing, etc., that is totally acceptable way to leverage your CTO or senior developer. But you do need that one owner of the technology. If you're a software business, of course, like if you're TPG, then you might have an owner of the product or operations. But you can't just outsource to devs and just be commercial people. I've done it. I can't, frankly, look at the code. And when our CTO, who's now joined us full time last year, he had a heart attack when he looked at the code base, and we couldn't stop that. And so if you come looking for your seed round, I'm going to think, and any other investor that knows seed companies is going to think, you guys are commercial. That's great. You might know how to build the product on the front end. You know what the UI needs to look like, but you've probably got so much technical debt, your customers are going to come unstuck. So yeah, absolutely can use outsourced devs, but would just do it sparingly, or do it with somebody at the top who can be an anchor of legitimacy.
Cool. Last question from me, and then I'll pass over to MA. You mentioned the word red flags, which we had as one of our questions as well. Any other red flags that if someone was or has in the past pitched you, you've been like, okay, I'm immediately turned off because you did this?
That's a really interesting question. So big red flags would be if you tell me your commercial progress and you're not being totally honest, like I said about the revenue thing. It's actually better to say you don't really have any material revenue than to say you've got some if it's really, really low quality and you want to claim it's ARR. So just say it like it is. Okay, don't try and. Oh, are you guys? Can you hear me? It says
We can hear you, but we can't see you moving.
Okay, can you hear me now?
Yeah.
Tell me when I'm back, and I'll keep
You're
going.
back. You're back.
Yeah, brilliant. Okay, and so I think the first thing is just don't lie, don't deceive an investor. And I know, I'm sure you won't, but so many founders try. They do it subconsciously. They want to paint a picture of a great business. And actually, sometimes you have to step back and go, like, is this true? Because that I'd probably say actually more than 6 out of 10 of businesses that we see that we turn down, and it's because we go look at their. I think in just this week, someone told us they had 600k of revenue, and they actually had 300,000 of revenue. And the other was onboarding fees. And it's just be honest. Just tell people about it. 300 grand's impressive. Like, don't lie. I'd also say don't over-egg your fund round. Don't say you want to raise 6 million quid or 4 million quid, because yes, it's ambitious. Yes, you can raise this money. Yes, you can try and dominate. The chances of you getting that round off are so low at the moment that you either have to go back to investors with your tail between your legs and say, I'm sorry guys, I'm now doing $1.5 million. Or you just don't raise a tool, or people say I'll be a co-investor, and that's worse because they're basically just saying, oh, they want someone with conviction to step up. So I would say keep a seed tight. $1.5 million, probably $1.5 million on average. $1.5 million to 2 million. If you get oversubscribed, trust me, investors will be cool if you're like, look, I've got loads of money here. I really do need to increase this round. So go out with something achievable. I think the other red flag, which I'm sure all of you have dealt with, is like branding. If you cannot brand your deck and you cannot brand your business well, don't talk to a VC, because branding is at the core of why you as a company are different to every other company. And understanding that that's important for differentiation is a key prerequisite for having a long-term business that's successful. And so it's a really bad heuristic if you let yourself down by having a deck that's like, this looks like it's been designed in Microsoft Paint. So pay for a designer, pay $1,000 for that designer to do your deck and make it look sexy, because that just stops you going into the no pile. There must be so many businesses that go into VC no piles just because the decks don't look pretty. An investor looks at your deck for about 2 minutes. The third red flag, you've got to understand your business really, or maybe fourth, you've got to understand your business really, really well. What I mean by that is put your business into 15 slides. Okay. If it's any more than 15 slides on a deck, you failed in your fundraising deck. And that's because investors have the attention spans of mice. And so you just have to get everything key across straight away. I'm sure this is something that Purdy and you guys will talk about like through the program. Those are sort of the key red flags. The other one, as I said, was things like hiring a head of strategy when you're a pre-seed business. It's like, what are you doing? But I think if you're just honest, frank with yourself, but really like confident in your idea, and have conviction that you know the market will move to where you're going, that will come across in a meeting, regardless of your own. You don't need to lie. But actually, you can just say like, we'll move, and you can explain why. Most investors don't know your space, and you'll love it when you meet an investor that does, because they'll really show they do. But like most investors don't know your space, and you actually have to educate them. So you have this opportunity to gain their trust in the first 10, 15 minutes of a meeting or call. And just don't blow it by talking garbage or putting a deck together that's not well designed, or saying something stupid about your revenue or commercial traction that's not true, that will come out 2 weeks later. Just play it straight, be honest. Ultimately, investors, every call they go into, they want to invest in you. They are literally looking for reasons. Like they are paid to do deals. Like it's a great match. Like, and it's just a case of just not ticking no boxes, not ticking a yes box. Just don't tick no boxes by doing these simple things right.
There's some questions coming in on the chat. I'm going to pass over to Em, who's going to ask a few and then manage the Q&A. If you do want to ask a question live, you can raise your hand using the raise hand feature on Zoom, and then we will head over so you can ask live. Even if you've already put it in the chat, that's fine. If not, just keep it in the chat and we will read it out. Em, I'll pass it over to you.
Cool. So I know you touched a little bit on salary, and I'm not sure if you saw the report from Sifted earlier this week when they said the average early stage founder paid themselves a salary of 80K, which was much higher than I've seen elsewhere in reports. What's a red flag salary for you?
So I think it depends on your personal circumstance, where you live and whether you have kids. So the blunt reality is you should not have founders taking more than 10% of the raise, ideally, and in salary. So for most people, that means salaries over 100K, because they're raising $1 million, $1.5 million. Anything over 100K at seed I would say, is in the red flag territory. I think you can only get away with 100K, frankly, if you've got kids. If you've got kids, investors understand that. They know that you can't be distracted by not being able to afford nursery for your kids, and so that's fine. If you don't have kids and you are living in London, which I guess is the step down from that in terms of like salary, that 80K, which is euros, 70,000-ish pounds, is about what we see actually. Like that's a good number. Like 70K, no one's going to argue with you, right? It's about not ticking the no box. No one's going to argue with you at 70K. At 80K, people are like, oh, high, but I can probably get comfortable. 90 and 100, they're asking questions. And unless you got kids, people will be put off by it.
It's good to get clarity on the answers on this, like you just said, because it's so opaque otherwise. Yeah.
And it's also heuristic that moves forever. Like, I mean, back 5-6 years ago, it was 50-60K for a seed founder. It's obviously moved up.
So I want to touch quickly more on due diligence. What are you looking for, let's say, during like the first phase of due diligence, when you're still on the fence and wanting to learn more about the company? And also, what are things that founders should view as red flags from investors if they're asking for in due diligence?
That's really interesting, because the one thing I've learned over the years, regrettably, having raised and been a VC, is that there is no homogenous VC process, and every VC tells you there's this process. I can tell you, if you have a term sheet from Index, that process will not exist. And so it's quite difficult because it's totally dependent on your circumstance. So we just take the average here, right? On average, and what am I looking for? The first thing I'm looking at is the team. I'm thinking the judge I use, and every VC has a derivative of this, but mine is, if I were to leave tomorrow, would I start business with this person? That's a personal heuristic. You can say, Seb, like, you're not like everyone. You're saying you've got to get along with people to do deals. Yeah, I do. That's why you have a diverse investment team, hopefully, so that you can cover all these bases. Every investor has their heuristics. So I'm looking and thinking, can I work with you? Do I like the way you think? Do I like the way you problem solve? Do you have a confident humility? You know, are you confident in what you know and humble about what you don't? Are you able to explain your market and product simply? Can you explain it to your grandma? If you cannot, do not go into a meeting with an investor, because trust me, half the time they don't know more than your grandma, at least in the first meeting. And I think after I've got comfortable with that sort of ability, you could say charisma to some extent, but it's not just charisma, it's also knowledge and attention to detail. Once I've got comfortable with that, I'm then trying to understand a little bit more about the customers. And really that's the market, but you can go at it like, what is the market? Is it big enough? It's almost a tick box exercise. That is, do not do something top down. Do not tell me Gartner's X big. I don't care. What I want to know is your price times by the number of people you can sell to. What's your TAM? That is your TAM. Like, don't do any top down stuff. Big red flag. Investors look at it and just laugh you out of the room. If I'm looking then at the customers, I'm wanting to understand that they feel there is a feature set or an understanding of their needs that wasn't there before. You know, why did Salesforce do well? There were other things that could be used for recording sales CRM, even paper, but they just understood the need better. And that's that talking to customers. Why do we use Spotify and not Apple and not Apple Music? You might use, or iTunes, right? Like, it's just they understood the streaming need better. Like, what I want to see is that when I'm talking to your customers. So get ready, tee up a handful of customers, maybe 2 or 3. 3 is probably the best, that you really get along with. You could even say, look, I'm going into fundraising season. I'll take you out for a great meal afterwards. If you're good relationship, I'll take you out a great meal. Is it all right if I use you as somebody that, you know, a few VCs will talk to? You know, it might be a bit annoying. It'll be quite interesting because you get to see what their questions are. Have that teed up. If you don't have customers who are ready to sort of reel off why you're great, then it'll come out in the DD. So those are the things that I'm thinking about as sort of the first next steps. You know, things I'm not looking at here, just so you know, I'm not looking at your legal agreement until I'm, you know, your service agreement as an employee until you know you're going to legals. I'm not looking at something like, I'm not looking at your win-loss ratio at the early stage, because it will be seriously high on the loss, or it will be so few pieces of data that it's useless to look at. So I might look at your pipeline, but I'm not going to look at your win-loss ratio. I ultimately will be getting comfort if you are responsive to me. So it's a bit annoying because VCs are capricious. You know, they have lots of meetings and they'll say they won't get back to you for 3 days. And then they'll say, hey, can you send me this? And it's bloody annoying, but you almost, when you're in fundraising season, have to drop what you're doing when a VC asks you for something, even if they've been slow. You've got to dance to their tune. The number of good founders I meet who are like, Jesus, I hate fundraising. These investors, they're just so average. They just ask me silly questions and they just ask for information that's so basic. Yeah, go on that ride, right? Go on that ride. And if you do that well, you will get funding. And the blunt reality is, as long as they're nice enough people and not malicious, that's a good investor for a good founder. A good founder knows where they're going, and their investor is another sounding board, not going to run the business for you. And so I think that having that patience is really important. And was there a second question nested in there, or was that, did I answer that fully?
No, I think you covered it perfectly. That's really useful. Okay, first question we're going to take is from Maya. Great question. We are piloting with an enterprise brand, and when we convert them to yearly contracts, is that considered reoccurring revenue for you? Considered reoccurring revenue. We've heard some funds say that they want to see evidence of contracts that are multi-year to call them reoccurring. So question is, how do you define ARR, especially during a pilot phase?
Yeah, I think that sounds like a tough investor that's giving you that, right? So what I would typically expect to see, and a very market standard SaaS contract these days, is to have a sort of annual term auto renewing. And of course they can cancel every year, but it's a sort of auto renewing contract. So you have 12-month contracts, but they auto renew. I wouldn't, if you can, and you can't always, particularly with big enterprise, but I wouldn't always try and have contracts that go dead at the end of the year. And the argument to the corporate or to your customer is, look, if you like this, we just want to keep going, right? And you've got the opportunity to cancel every year. So don't worry about the fact it's auto renewing. You can still cancel. And that looks quite nice, because then the investor basically looks at it and says, right, the default position here, you know, the nudges in the world, default position here is your multi-year unless you fuck it up. Sorry, this is going recording. I probably shouldn't swear. And that multi-year question that you've received, I think it's Maya that asked the question. Like that multi-year question is tough, because signing 2, 3, 4 year contracts is not common at the seed stage. Like, you do that is exceptional, and you should know that's exceptional. And if a VC is asking you for that, they've probably got a lack of conviction around the market, dare I say it, potentially you or something else, and they're putting the bar higher in the revenue. I don't think having multi-year contracts is needed to call them recurring. They're recurring if by default they recur, which can be auto renew.
That's a really helpful answer. Okay, next question is from Bobby. How do you approach funds when you essentially need to raise in order to launch your product because you're in a highly regulated industry?
Yeah, so my business is a fintech, so I've acutely felt this pain. And frankly, one element of my business cannot be done until I raise my next round. But there are things I can do in the meantime, right? There are. This is where we come back to the first questions that Purdy and I were discussing about, like, you know, LOIs, those advocates in the corporates that we're willing to talk for you. These things that aren't revenue, that show that, look, if I get this, I'm golden. Like, these people want this product. It's normally, it depends on what you are in fintech, but often you can use an AR arrangement in fintech. And it's a bit more expensive than being directly regulated, but it does allow you to product market test. And so depending on what you are, if an AR arrangement is open to you, I would expect you to be doing that at pre-seed. If it's not open to you, then fine. Yeah, I get you. Like, there's a business plan, the lending business, that, you know, basically did a round and they didn't have revenue because they could not get the authorization at that point. And, you know, investors understood that. They understood that, and they looked at the team, and they looked at the way they were developing a pipeline, and sort of like, when you get to the start line, how quickly can you jump? And I think that's how you deal with that point, is you talk about how it's just the last thing. It's the cherry on the cake. If you use it as an excuse to say, I haven't built anything, I don't have anything, I haven't spoken to customers, I haven't tested the market, then
yeah.
Oh, I think someone came off mute.
Fine. But yeah, but no, that was it. I was just finishing there. So yeah, so I think you can always find something to talk about, and indeed you have to, because if you're doing a seed round, yeah, that's the tough thing with deep tech, is that it's very difficult to find a lot of things to talk about when you're building that technology, and that's why they struggle to raise, and the failure rate's really high in deep tech, and that is a risk in fintech. But the way you counter it is by having these other items that you can build a narrative around.
Great. Okay, next question. This has come up a few times and you've touched on it. What are VC's thoughts on volatile revenue? We've just launched our SaaS model, but our agency offering still drives most of our revenue, which is more ad hoc. And so far, I think you've said a lot around, like, just clarity and honesty on breaking down those numbers. But is there anything else that you'd add on that?
I think what you have to be, so the big takeaway here, and you see this sometimes, and this can be either a strength or a weakness, depending on how you play it. It can be a weakness if you try and claim that your revenue is 2 million and it's actually, 100K of SaaS and 1.9 million of service revenue because you were a consultancy that's moving and pivoting to SaaS. Like, doing that, you're just going to get the investors disappointed. You're going to get so piped up by their large amount of money that you're generating, and then they're going to just look under the hood and be like, this is all not the case. Really, what you have to do in this situation is make very clear SaaS is your focus. I have this agency model. It's not the future. We are a dev-focused, dev-centric, product-led team. You might not do product-led sales, but your product is the core focus of your business. And the agency was what gave us the deep knowledge of the sector. And indeed, that's our unfair advantage, because we know all the people and we've worked in the sector and we've seen the problems. And we're now a SaaS business, and we are not, and you can say, we're not going to renew any of these contracts, sort of thing. So yeah, so that's how I would deal with that. Honesty combined with making it really clear, you know what the priority is.
Not to get too granular on this, but I know it's a question that comes up for founders. If you're in that situation, and let's say you're doing a lot of cold outreach and you're just putting numbers on a deck, and so you have to essentially communicate that situation on the deck, should you put that in the like, why we're the right people to solve this problem, rather than this is like our revenue situation?
Yeah, I would be, what you want to do is set up an investor for pleasant surprises. So if you do a revenue slide which has this big amount of revenue, and then you go to the meeting and you say, oh guys, by the way, this revenue is actually an agency, you've just set the investor up for disappointment and you're likely to get a no. If you totally exclude that revenue from a revenue slide, and you go to the meeting and you say, as you've said on the slide about the team, that you've got deep expertise and you've run this business, etc., and work with this number of clients, blah blah blah, and then you go to the meeting and say, oh yeah, and by the way, we've totally wound down the agency thing, but it still generates legacy revenue of like X amount, but it's not taking up our time. We're focused on the other thing. That's key. Then I think that's a pleasant surprise. Oh, great! These guys know how to actually, generate revenue and earn some money. So you played right. It can be a positive.
Perfect. Okay, I'm going to take one question from Leonie in the chat, and then Ollie and Ewan will go to you. Okay, so Leonie asked, how do investors view a time issue? We incorporated in 2018, raised an angel round in 2019, and another pre-seed late in 2021. We are revenue generating. Is it seen poorly that we started in 2018?
Okay, well, the blunt answer is yes, it is not. It's not great. Like, you're going to fight that argument. I think the narrative you need here, because it's all storytelling, is that you incorporated the business in 2018, but you didn't go full time and really focus on the business until you raised your pre-seed round, the 200K, and the 60K you raised just like exploratory money, and you were just looking at it. This can be, by the way, a fiction, but it's about narrative. It's saying, like, we were exploring, but we really went full tilt at Datex. 2018 raising a seed round, that's a long time. That's 5 years this year. That's not venture backable. So you really do need to make sure that your narrative is, or at least not ostensibly venture backable. So I think you just need to nuance that narrative a little bit about what you were doing at the beginning.
Okay. Ollie, I said I was going to call on you, but your hand went down. So I will move on to Ewan, but if you did in fact have that question, just message me.
Hey, sort of question around if you've got like more of a deep tech type startup at like the pre-seed or seed stage, obviously they tend to require a few more pennies than like a non-deep tech company. So I wondered, one, at the raise amount, if it's still okay to raise at £2 million kind of pound level as a deep tech company at pre-seed seed, if they can generate revenue straight after funding as well.
So you're saying that can you raise a 2 million round if the narrative is you will generate revenue after the round,
while also being a deep tech company as well?
I think being a deep tech company in and of itself isn't an issue. The issue is that deep tech products, because they often have like large data sets required, they just and they can be quite complicated in how they're applied to use cases. They can just take longer to develop. For what you're saying there about raise 2 million and be revenue generating after the seed, that's fine. I think the issue is that you just need to explain why. It comes back to the same point that was asked earlier about what if you need the regulation to get your revenue. You need to just explain like why that money is going to get you there and what you're doing now to prove that you've got market fit, or at least tentative early market demand. That's how you get over the line there. Deep tech in some cases is harder to raise for because investors have this instant like, oh, it's going to take a long time. But in some ways it's easier because you have an understanding of the investor. The investor understands when you say I'm a deep tech and I don't have revenue yet. So it can cut both ways depending on who your investor is. And there are some specialist deep tech investors. Octopus has a couple, Speed Invest have a couple, and you probably want to speak to them, in your round because they might have a greater understanding of the capital sort of velocity of the business than perhaps a generalist VC.
All right, let's
Thank
move
you.
on to Ajit.
Hello.
Hey, Eddie.
Hi. Great talk so far. I have a question regarding B2C model, where you said those B2Cs that may not have started generating revenue yet, if they can show a proof of building customer loyalty and then project it how they can translate that into revenue in the future, is an equivalent of LOI from the B2B space. So now, could you give some examples of like basically how could that mapping be done from how could that mapping be done from, okay, I have users who are regularly engaging with the platform, and mapping that to these users will pay.
Well, so the way that most businesses, it's super in the problem with consumer, I should add, is that in explaining it in this forum, is that consumer businesses cut so many ways that what works for one is not necessarily going to work for another. And B2B obviously has that, but there are archetypes in B2B, and you fit into probably one of the several. In this particular case, I think the narrative is if people are using your product, you just have to make that logic step. You assume a fair amount of drop off when you monetize, and you frankly look at an Excel spreadsheet and go, does this look compelling? And you massage your numbers between believable and compelling for effectively what your revenue model should be and what your drop off should be. And you could increase the revenue and drop the drop off rate. But those are the two levers I would use if I were you to be trying to get that number. And you need to be showing that sort of few $100,000 number, right?
All right, Ludmila had a question in the chat, but she's going to ask it live. We only have about 7 minutes left, so we're going to do this really rapid fire.
Okay, thank you. Just a quick one. We launched our product in October, and we are now generating revenue 10K ARR, so very slow, very small as you are talking. But how fast do you expect those companies to grow their revenue? So what are the traction expected?
The way I kind of think about it is between pre-seed. First of all, great job. Like that sounds really promising. You say 10K is not a lot. That 10K MRR, if it's recurring, that's decent. Well done. I guess it is recurring.
Yeah, ARR, not MRR. Yeah.
ARR, 10K ARR. Yeah, fine. Well, it's revenue still, right? I think. Sorry, could you just ask your question again so I make sure I answer exactly right?
Yeah, so how fast VCs expect this to grow to 100K?
Okay. I'm not going to answer to 100K. I'll answer to your next round, right? So what do you need to get to your next round? So that 10K does not need to have an absolute growth rate attached to it, because in that pre-seed to seed gap, you are just establishing customers. And for one business, it might be 2 customers that are 100K contracts and they've established that there's something there. For another business, it might be 100 customers, for 1K contracts, a lot of very different work and also different growth rates. Those 2 customers can happen. You can have that growth in a month and then nothing for a couple of months after that. And so really, I don't think you need to worry about growth rate. Worry about what you will be worrying about internally, which is, do I feel like the revenue I have now is proving this is a thing? And you know it. We all know it as founders, right? We've all got our businesses. They're all our babies. And you should just be looking at it and saying, like, 10K, you might be like, this is exciting, but I know that this could have been luck. Or I've spoken to someone and I got all my friends on there, sort of thing. 100K, you're starting to feel like, okay, I've got decent demand here. There's a lot of people here who are interested. Whether you do that in in 1 month or 10 months, it's fine. The key thing is just not to leave between your pre-seed and your 6-figure number of ARR at some point. Try not to leave more than 2 years generally in your round. But when you start generating revenue, don't worry. Don't be like, oh goodness, I've started revenue generation here. I have to now hit 20% month to month because that's what I hear what VCs say. That comes in when you're post the seed round, when you are building that sales process, because ultimately that month to month growth is not only evidence of product market fit, but your ability to systemize things internally. And at this stage, your systemization is not the key thing we're controlling for. We're controlling for core early product market fit. Does that make sense?
Yes, thank you.
All right, Cam, over to you.
Sorry. Hey, Seb. Thanks for the chat so far. Yeah, I guess my question, I already kind of posted in the chat, but it's around, we don't have we're a fintech lender, and we're going to help first-time buyers get on the property ladder faster by supplemental deposits. So it's not a reoccurring revenue month to month. It's very much, it's an arrangement fee, charged to the home buyer, and then a servicing, and we get the yield spread from lenders. So I guess, what do you kind of look for on that end in order to be like as an investor?
So you're obviously not, as you hinted at in your comment, which I've read, you're not recurring. That's not necessarily a problem, but you just need to then go and look at what are comparable businesses to mine, old world businesses to mine, using as their core metrics. For example, InsurTechs will often look at GWP, loss, their loss rates, and sort of what their take rate is if they're an MGA, and that's obviously not ARR, right? But somebody can go and can look at another MGA and can compare this business to that business and know whether you guys have got something going on. ARR is the laziest, easiest thing to explain on a call for an hour because it's just very basic. For you in lending, loss ratio is going to be key, like origination. Origination rate is going to be key. Your decline rate. What's your underwriting model? Like, how are you underwriting? So how are you pricing? Or if you're just an intermediary, how are you pricing your arrangement fee? And why is paying you an arrangement fee better than going somewhere else? It might be that there's no other option. But I think you need to. I think you just need to be having a look at other businesses in the lending space that are doing something similar to you. I appreciate you're doing something novel, hence it's an opportunity, but there will be other lenders very established with their metrics that they'll use.
Right. I guess sorry, one more question.
Sorry, we only have 1 minute left, so I'm gonna have to cut you off, Cam. Sorry.
Fair enough.
Sorry. Next week.
Okay. Cam, drop me an email, Cam.
Perfect, thanks. One question that's come up in the chat several times is, what are the actual metrics that you use to determine product market fit?
It's like the Supreme Court when they talked about pornography in the US. You know it when you see it. It's like with some businesses, there is no answer there. Is the quick answer. It's a great question. It's highly dependent on the business. You might have a business, basically product market fit, you've probably all read about it, but product market fit is the feeling that there are enough people saying they want your product, you physically can't build what you're promising at the speed that people want it. Like that is the great indication of product market fit. If you're not feeling that, you haven't yet reached product market fit. It's like love. You either know you feel it or you don't. At least I hope everyone knows what love feels like. And so product market fit is the same thing, and VCs will see it as well. For example, if you have got 2 founders and a CTO, and you've got 6 contracts totaling 250 grand of contracted ARR, you might not have received it all, but contracted. I would say that's pretty good early product market fit, because I can tell that team of 3 will be stressing out to deliver for those 6 people. There's no way they're likely to deliver for those 6 people perfectly. A consumer lender, you might be originating or talking to 1,000 people, or like a credit builder, for example. You might need 1,000, 2,000 people using your product before there's any sign of product market fit. And so it's really dependent on the business. And the thing is that you don't need at seed to have full product market fit. You don't need to feel that like this is flying off the shelves, but you do have to know there's some demand. Otherwise, you will probably waste a lot of time trying to raise money in this environment and not succeed. And that's blunt, but like this is the brutality of business. It's like it's just black and white. You will feel it when you have it. Is all I can say. And that VCs will know it as well. And I've just given you a couple of examples, but yeah, for your particular business asking this question, feel free to email me and we can talk about it.
Okay, perfect. Thanks.
And actually, Sean has just put quite an interesting link in the chat, which is Sean Ellis's product market fit survey. But again, the fact it's a survey just shows you how wide that definition really can be.
Perfect. Would you have 30 seconds to answer one more question for Francisco? Okay, perfect.
Yeah, sure.
Go for it.
I said, thank you. I'm going to be quick. So what is the narrative on your side when you see a business selling a subscription to a business, but those businesses don't consider themselves as a business, at least in the nature, so sports teams. And obviously there is also the seasonality. Sports teams only make their investment sort of the beginning of the season, which meant a very long sales cycle, demonstrating revenue on that sales cycle, even longer, and seeking investment on their sort of their environment.
So we will always look at the type of business, so whether that's enterprise, mid, SME, or SMB as they call it in the US, or in your case I would say it's like we have another word for it, but like unincorporated associations might be one. Like they may be small sport clubs, or if they're big sports clubs, they're fundamentally sports businesses. I think we will not think of your business model as different. We will think of your market sizing as different. We will size your market based on who your potential customers are. And sports is a really interesting market. If you're in a multidiscipline, if you're in one discipline, you can find that you have a bit of restriction on market size.
Okay.
All right, we are at time. If you didn't get your questions answered today, we have Dan Bauer, founder of Superseed VC, and next Wednesday and on the Monday we have Rory, the founder of Trumpet, and Anthony, the founder of Seed Legals, in as well. You'll get an email from us shortly. But Seb, thank you so much for joining us today.
Thanks.
You're a
make sure you go to Rory.
so
Make sure you go to Rory's talk, because he's in our portfolio.
Oh, really? Oh, perfect. Okay, we'll ask him what he thinks of his VC then.
give me a link so I can watch.
Yeah. Sounds good. Thanks.
Everyone that wants to contact you, should we just link to?
Yeah. You can send them my email. Yeah, for sure.
Okay. All right.
Perfect.
Cool.
Thanks so much. Founders will stick around for a few minutes in case anyone has any questions. If not, see you on Monday.
Great. Thanks, guys. See you later.
Thanks. Bye.